What's going on, everybody, and welcome back to another episode of the Next Big Thing podcast, where we interview the founders and CEOs of crowdfunding startups. Today, we welcome on John R. Green, the co-founder and CEO of Nada, a wealth tech platform that is unlocking equity in the world's top cities. Nada was founded on the belief that investing in real estate is unnecessarily complicated. They look to level the playing field with investment products that promote transparency and are simple and easy for users to navigate. Their platform allows anyone to access these investments for as little as $100, and homeowners can also access their home equity with no monthly payments. In addition to his time founding Nada, John has an extensive background in the financial sector, working for companies such as JP and Pacific Union Financial, and is currently a member of the Forbes Finance Council. Within Nada, John is also the general partner behind their flagship offering, CityFunds, where investors can own a piece of diversified real estate portfolios in the nation's top cities. Nada is currently raising on WeFunder, and the link will be in the episode description. With that being said, John, thank you for taking the time to join us today, and welcome on the Next Big Thing podcast.
That's awesome. Thanks for having me. I appreciate it. That was a mouthful. That was well done.
Yeah.
I think we can call it. I'm pretty sure you summarized everything well.
Yeah, I mean, it's, when you get in the financial sector, me and Connor have accounting backgrounds. There's a lot of just mouthful words. So I wanted to make sure I got all that in there.
Yeah, it's a bunch of jargon.
Yeah, a bunch of jargon.
Yeah, you did good. You did good. I appreciate
Thanks,
it.
John. Why don't you tell us the story behind Nada? How did the idea come and, becoming what it is today?
Yeah, sure. Maybe I'll start with a bit of a disclaimer as to who I am. So I'm from a very small town in North Louisiana. Whenever I was 18, me and some friends started a punk rock band. Somehow we started getting serious. We got signed by a record label, and I ended up doing that 4 years full time. Did 2 albums, toured all over. So I had this like mini career as a very young person, making crazy decisions as a punk rocker. All right, tuck that away, but know it. And then I got opportunities to start working in, you said it well, I got to work with mortgage banks. In that sector, I was actually at WAMU. WAMU got acquired by JP as a bit of a takeover, kind of segued through that. I did 10 years in that space. Financial strategy and risk analysis to, innovation and really just joint ventures, new business mergers, et cetera. But I got kind of this duality of mindset and viewpoint on life. I've got like this, anarchist punk rocker view of like everything should be like authentic and real and everything's bullshit. And then I've got this like really structured, business finance mindset. So I view the world differently. So I view the world as like, okay, real estate specific as an asset is something that like I imagine you guys are experiencing right now. You're sitting in something that is, categorically real estate. It is that every day in life. But how we talk about financing it, accessing it, managing it, whatever the jargon, the language, the math of it, it's also damn like specialized. And it's very much exclusive across the board, as if it's something more complicated than what it actually is. And I fundamentally don't agree with that viewpoint on anything, like gatekeepers around, information access, et cetera. So that was by and large the motivation. As I spent my career in financial services, I got, greater, higher and higher up the corporate ladder, whatever you want to say, to where I could really see how the decisions were being made, products were being distributed, and, how people were accessing them. And it was maddening. There was not some secret room you're going to get to where it made sense. And so we set out with Nada. We said, okay, we're going to take this asset and we're going to create as many products and language around this that makes it most accessible to everyone and just go from there. So like, how can you look at financing a home without it being debt? What does that even mean when we work through that? I'm going to kind of slow play some of the products, but really everything is fundamentally on that. I want the language to be simple, not exclusive and making someone feel uncomfortable. And I want the products to be open-minded and creative, adjacent to other industry products, et cetera, so that we can create more access and ultimately wealth to real estate for a mass market. So that's the spirit of who we are. We're very much a spirit-driven, purpose-driven company, and the products are, kind of the outcome of that.
So, John, doing some research, I came across the mission of Nada, which is to make real estate more accessible for everyone. So can you walk us through how Nada is accomplishing that mission or striving to accomplish that mission?
Yeah. Thank you. So you look at the U.S. housing market. So the U.S. residential market, it's $40 trillion. It's the largest, asset class here. Within that, around 27 trillion of it is home equity. That's the equity position of the people that own the home. So that's the value of the home minus the outstanding debt. So 27 trillion of a near 40 trillion market. By and large, that's trapped. It's illiquid. If you bought a home like a year ago, 2 years ago, it's even worse, then your interest rate on your mortgage is such that you do not want to take on new debt to access that. Just the same, you probably do not want to move, right? Because you're going to have to move out of that rate into a new one, and it's just you're trapped. So you can't sell your home, you can't refinance it, but you got this value that's built up. Like it was this unprecedented amount of home appreciation and equity, but you can't access it. So you've got on the debt side, it's the $13 trillion side. That's where Chase, that's where Wells Fargo, that's where Quicken Loans, everyone is competing to give you debt. But there is, like, inclusive of my company, around 5 people that are doing an equity-based financing. So I'm going to take a leap of faith here and think that this audience has some understanding of a safe note and how that works in venture capital. So I run a startup. I don't get that excited about going and getting a loan. I want someone to bet into the future of the value that I'm building. So I look for a safe note, an equity investment that converts into future stock value based on the value that I'm creating in my company. So we basically created a financial product that follows the same principles. So we will go to a homeowner and say, hey, you've got great equity. This home should continue to appreciate, and we want to buy a position of it, right? We want to come in and buy this out. We'll give you cash today, but we're going to secure it with a lien and an option that's going to convert into actual value to us in the event of a trigger, like an IPO concept, right? So this trigger for us is the refinance of the mortgage, the selling of the home, or of course the expiration of the term. And so this creates an entirely new product for a homeowner that now they can sell a piece of their future value, get cash today, offset any inflation, invest in their kids' school. Right now we have a lot of homeowners that are using it to invest in solar. They're putting solar to their home. So you've got this economic value. You also even have this kind of greater environmental impact around sustainability, urbanism, everything. People can kind of stay where they want to live, and they can perpetuate the value of it. But it's all around looking at that asset differently. And the fact that it's so alien to think of equity financing on this asset that everyone lives is kind of that's the punk rocker in me saying that's stupid. There's equity financing on pretty much every asset. Why is that so weird for this? So that's one product. That's we originate that asset. We call it a home share. Simple language, right? So that's at least our attempt there. It's a home share. It's mainly competing against a HELOC, which is an abbreviation of a freaking technical term. So therein lies my point. But a home share is the primary asset that we're originating, and in this instance, it's helping homeowners unlock equity. We take that asset and we pool it into our real estate investment funds. And so we're only buying these in like certain major markets. And I always see major markets as major metro areas. So we have Dallas, for example. We have a fund that we call a City Fund. That fund is available to public investors. And the Dallas City Fund owns a bunch of these fractional investments in homes. So it's a new way to invest in real estate for everyone. So we've taken a problem on one side and unlocked it. So a homeowner can access it, they can spend it, they can do whatever they're going to do with that cash. Okay? Now this becomes an asset to where we've got a stake in a home, like how this audience may consider making an investment in us and getting a stake in a company. We have a stake in multiple homes. And we said, okay, now retail investors, anyone, you don't have to be accredited, you can invest in homes in Dallas. That's where it gets into where you can do it for as little as $100, right? So it's two-sided good. That's really kind of our spirit. Is like when we create a product, is someone getting screwed over? We work it through end to end, and in this case, everyone's kind of an all ships rise.
So I want to first start and just focus on the home share program. Very similar to a venture capitalist, they're buying equity in a startup, predicting that the startup will increase in value later on. You're doing the same with these homes. Now, what is the relationship between Nada, you and Nada, and the owners of the homes? Is it more of a partnership? Is it a different type of relationship? Can you go more into that relationship and why that homeowner would want to cash in on their equity now?
Okay, yeah, that's a good question. So the easiest way to think of that relationship between NADA and homeowner is that it is most like a mortgage originator it has with a homeowner. In this case, like a homeowner is looking for some way to access equity, to cash out their equity. That's their motivation. They've got their reasons. In most cases, it's brought to us because they're investing in a home improvement. They're investing in adding solar, as you said earlier. These are the common things because a partner of ours, just to give you this entry point, would say, hey, I sell solar, and that's my job. I'm talking to the homeowner. I sell solar. Did you know you can actually pay for this solar installation and equipment using your home equity? And then that's how a customer, homeowner, would come to NADA and say, okay, I'm interested in this type of financing. And then we have a call center of licensed mortgage loan officers actually that offer this product. So you walk them through it. We do qualifications, et cetera. But that's the relationship. So we're the asset originator. And then once it's closed and funded and they've received their cash, we are also the servicing entity. We have some partners that help us, but in the event they have questions or we see something that gets off on their mortgage payments, et cetera, we're still with them. So they maintain a relationship with us.
And then for the home share program, is this any type of real estate? Is it residential or just commercial? Who are you targeting for the home share program?
Yeah, it's only residential, only.
So if you were to walk me through one of these type of deals, what are the terms on a deal? Let's just say I have a home, I have $1 million home, I have 800,000 in equity, and I want 100,000 in cash. What are the terms that you're going to get in that type of deal?
So just like you can imagine with any financial product, there's qualifying nuances to what we're going to price it out at. But I'll give you kind of the vanilla scenario here. A typical no issue owner occupied home. The first thing we're going to do is say, okay, what's the appraised value of the home? You said it was $1 million, and without any risk factors, we're going to say, okay, well, we're going to consider that at a 90% of, or said differently, a 10% discount to that value. That's how we get some downside protection if we're looking to place an investment. So we actually say, and it'd be negotiated, that, hey, we're presuming, because it could go down, et cetera, that your home is actually worth $900,000.
Okay. So
now what we're going to do is you want to sell a piece of your equity. You said your debt outstanding was $800,000. So in this case, you have $100,000 per our agreed calculation of equity. Mm-hmm. Okay. So when we come in and say we would never give you all of that. That's too much risk. But I'm going to walk you through the math. Let's just presume that this scenario would work. Say you went at $50,000. Mm-hmm. Okay. So $50,000. So we just bought $50,000 of your equity, which is your value above, your debt. And so in exchange, you're going to give us a lien secured interest to 50% of your home's future value above its current agreed rate. So that way it's very specific in that it's the future value. So it can only be equity based on appreciation. It has no consideration to you paying down your mortgage, which could be adverse. So we're not going to hurt you because you pay down your mortgage. You may, get excited and just say, I'm going to pay the whole thing off. That doesn't affect our stake.
Right. Okay. So it's almost creating a separate equity stake that's doesn't necessarily have to do with any sort of future debt obligations that you had already had with the bank. You're creating a separate equity stake that is purely based on the future value of the home.
Correct.
Gotcha. Okay, that makes sense because the first time when I saw NADA, my mind immediately went to platforms like Fundrise or Yield Street, which are platforms that are taking more commercial assets or taking together residential assets and basing it on rental income and things like that. But NADA is completely different in a sense. So you mentioned 5 different platforms that are really doing what you're doing. Can you talk about those 5 and maybe from a lens of what do you guys do better than those 5?
Well, so saying they do what we do is maybe a bit misleading, but there are 4. Where would be one of the 5. Gotcha. So there are 4 other companies that seem to have some real traction behind this type of financing for homeowners. I'd say 2 of which really in market have positioned themselves as a primary alternative to reverse mortgages. So these are home equity conversion mortgages. that are for the elderly, typically, right? So they have a different use case. They're more the way that they take so much appreciation in exchange for them giving you cash. You could say it's a little bit predatory, but people are looking at it, they're getting it, they want it. But that's really, they're more like, compare this to a debt consolidation or a reverse mortgage as far as the stake we're taking. And they've been doing it for some time. And there are two others that are doing the product much more exactly like a mortgage company is, which I don't think is wrong. I think it's a high value add, but it's very much transactional. We as a company view real estate as a long-term asset, and our process across the board is very much relational, like long-term relationship with this asset. How do you make more money out of it? Like a lot of our homeowners that are getting cash out of their home do end up investing across the CityFunds. It's a way to diversify their interest in equity across multiple homes. So it's really our approach, and how we do it, as well as a bit of the nuance of pricing. We're taking an approach with pricing this product as if it will have to conform with the Consumer Financial Protection Bureau and certain state laws around just really max returns, et cetera. So we put a lot of caps and everything. We really built it in to be sustainable, to where it's a product that can be mass market. It's a bit nuanced, but those are the distinctions.
Gotcha. And then transitioning from the home equity type stuff to now the CityFunds, which is comprised of those different residential interests. What would an investor, someone that wanted to invest in a city fund, what's the perfect investor look like for that?
This is hard because you've got really anyone that has an appreciation of residential real estate, and that could be as simple as go back to a bit of consumerism here, but the American dream, right? Really, what does that entail? That means it's like there's a wealth symbol and some type of status around owning a home. So fundamentally, I think most of us understand that like home ownership is valuable, right? It appreciates in value. So that's a very simple low bar of like what could bring you to it. Because we want our fund to be the entry point to real estate ownership. And I say that intentionally. It doesn't have to be that it's your investment in it. If you would, a lot of people don't own a home, but they see the value in that. And this is that opportunity. So it goes from there to where we have the same to where, an individual credit investor that may have had a targeted allocation to real estate as an asset, and there could be losing their ass right now because it was overly exposed to commercial real estate, which for many factors is way down, right? It could have even been in rental properties, which is also having a hardship. But this is a subclass that now you kind of want a real estate nerd out. You say, okay, this is the only public fund that allows me to invest alongside homeowners in this equity stake. And it's a very different asset. I very much like that. And then they kind of go all in. So it is broad, but that first draw of like, I think residential is something I believe in, where you're gathering home for that.
Right. And, when you think about it, a lot of people only own one home in their entire life, but it's such an amazing real estate class to invest in when, you're not investing just for rental, when you can have an interest in other people's lives and other people's American dream, as you're saying. It's a very different approach than a lot of other real estate platforms are taking. What opportunities and constraints are you guys experiencing right now?
So let's talk about the opportunities. Opportunities are, current state of macroeconomic conditions are that a high volume of homeowners want a product like what we offer. We are still an early stage company, so we're steadily scaling to meet that demand. The other core challenge to get that out is, in order to originate an asset like this that is different, is you have to have cash to fund it. We can only fund and carry so much as a top co until we have to sell it to our city funds or investors. And so balancing that relationship out is a consistent opportunity, but a positive one. We have more asset deal flow than we can currently meet. We just expanded to Colorado this month, actually. We're going to be launching the Denver City Fund, and Colorado is going to be a new market for us, and then Phoenix is going to follow. And so we're getting that playbook, but the homeowners that want to have a product like this in current state is an opportunity for us to meet, and we're taking that on. So I'm raising some new capital right now, in fact.
So you mentioned
What was the other? Oh, go ahead.
I think the the constraints. What are the constraints you're facing right now?
Oh, I guess kind of I've answered both of them.
We can get to the next question too. That's fine.
Unintentional, but
Um,
the constraints are the velocity of raising capital for a city fund, right? So we can raise on our investment platform, we're raising 700,000 to $1 million a month from investors, and some big checks can kind of like sway that. But that's really like we've kind of modeled that out based on my headcount for customer support, my investor relations team, and my origination team for assets. Everybody's working really hard. Let's say it that way. So that's good. I can do that, but I could probably originate 20 million based on demand volume of these assets, and so that's a constraint. So one of the use cases of the current capital we're taking on is that we have a partner warehouse credit facility that's going to work with us. That we have a term sheet with them for up to $20 million that we can take on as a warehouse facility, and that way we can put, instead of us just putting it in our bank account, right? We can fund more home shares to start being closer to demand, and then long-term sell them into city funds, instead of just having that limitation. But it takes, you can imagine, you have to go through due diligence, a lot of legal work. So it costs some capital to get that off the ground, but it'll be a big multiple for us.
I do want to pivot a little bit and talk more about the city funds and how you decide what city to start your city funds in. I find that very fascinating. You have right now Miami, Dallas, Austin, Tampa, and soon Denver. So why those markets?
Yep.
What metrics are you looking at to pick those markets when creating the city fund?
Yeah, so we do a couple of things, and the first thing we do is to enter a state, we first get our origination license for mortgage, primary and secondary. That takes some time. Just that type of stuff is slow, and so we do that ahead of time. That's just a general entry point. But then when we look at the specific markets, we look at how does this MSA rank in terms of population? What is the current trend in terms of like GDP, other economic factors, employment rate, what's the airport travel like? Like, is it an active city? That way we have we try to mitigate the go with your gut. Go with your gut. You might pick a really, like I'm from Louisiana. New Orleans is really cool. I think it's really marketable. But if you look at the stats don't really, make sense. So we look at that. So we look at like, what is the general economic pulse of this metro area? We look at the housing stock. That means like, what type of housing is it? And so we look for areas that have a lot of what you call PUDs, planned unit developments, more standardized housing. It has a certain shelf life and more predictability and a more digestible buy box. It mitigates some of the underwriting. I'll give you the alternative. The alternative would be like San Francisco or Boston. Really cool markets, but really nuanced, kind of weird housing because a lot of older housing and harder to really underwrite and understand some of the nuances of it. So we look at that, and we look at generally the marketability of that city just the same. And so is this city something that people are relating to? Unless, Austin, for example, has, a big college, South by Southwest. So it's a lot of stuff that can people relate to it, and can they experience it? Because that's what we want them to come into. Like, hey, I went to school in Austin, or I just vacationed in Miami, et cetera. And then the housing market, what's the home price appreciation look like over the last 10 years, 5 years? What's it forecasted to be? All that factors into it, and there's kind of a sweet spot that all these fit into.
Can you walk me through, let's say I have $1,000, I want to invest in the City Fund of Miami because I love Miami. I think it's up and coming. I think it's going to continue to grow and get bigger and bigger. What's the minimum amount I can invest, and then how do I track my investment so I can see it increase or appreciate over time?
That's a great question. So to get into Miami, the minimum amount is just $100. It's the same for any of our funds. That is not the typical investment amount or what we recommend, but it's a price point that we thought was most accessible. So if you wanted to place an investment, you would download our app and then go through the basic onboarding that you would do for a WeFunder platform or a Robinhood platform. You call it from the business side, it's KYC, know your customer, and AML, anti-money laundering. We got to make sure we know who you are and that you're not someone pretending to be someone you're not. You're not a bad actor. Very basic stuff, right? So then you have an account, you swipe to make an investment, you connect your bank account via Plaid. Imagine most people are familiar with that. and it's pretty quick thereafter. I mean, you now have shares issued to you in that city, so you'll receive your subscription agreement, which is your contract granting you those shares. And the key thing with the funds is that we update share price based on the asset value, that we call it net asset value, and that's based on actual month-to-month mark that we're doing on each equity investment. We're just re-evaluating each home. And so you come in and you say, okay, I got in today. Right now you really want to focus before the end of the month because you're going to get share prices this month. They're going to update on 9/1, where actually the team just filed them with the SEC. So that's how you're going to see, okay, I think you could pick the market, like what market is doing well. I'll be honest, Austin is kind of doing this and then kind of like, kind of leveling. But if you go long term back, it's still like way up. It just had a high false peak, but it may be steady for a minute, right? But Miami and Tampa are booming. I mean, they're growing like crazy. Tampa's actually the highest growth. But that's just, read the internet. And then generally our investments are going to align with that. So you can say, okay, you picked a good one or you picked multiple. You can see your share value go up and you can track all that in the app. It's very heavily, geared towards driving your attention to what is net asset value? How does that translate to share price? This is actually directly correlated to those real estate assets. And, the value of your investment is going up, currently up, but always there's opportunity to go down too. But in the current case, we intend to continue making good investments and it's going up and you can track that all within the app.
And then circling back to the mission statement, making real estate accessible for everyone, I don't have to be an accredited investor to invest in the CityFunds of Miami, Denver, Tampa, right? Anyone can invest in them.
Absolutely. Yes, anyone. We spent almost a year, 10 months working with the SEC and FINRA. As you can imagine, this is adjacent to other concepts, but we really wanted to get everything set up. And October of last year, we were SEC qualified with these funds.
That is awesome. So it's like being able to buy stocks, but in real estate, and then you can track it month to month, see it appreciate. Oh, that's sweet. But I guess it leads me into my next question. You mentioned the SEC, and with these new ideas, there's always people that are going to be super dismissive or super pessimistic about the legality of it. So can you walk us through the SEC filings in order to make sure that you're following the steps and that I guess investors know that this is legit, you're following the steps, SEC, you get your license, whatever license you have to have. That way, I guess they trust the process.
Yeah, it's a great question. I mean, you're doing something different, especially in this sector. It's, you should always presume it's heavily regulated. So we take that very serious. We have institutional VCs that have invested in us. To give you a sense of some of the diligence around those areas, it's very much heightened. And from the origination side, I think I spoke to this. This is not technically a mortgage. So there technically is no governing licensing or anything on that. Yet it is so similar to a consumer finance product that we took the step to where we only originate with licensed mortgage originators and in states in which we carry the comparable mortgage licensing. So we do everything from that side based on that. When we deal with the SEC, we file everything publicly. So our CityFunds are SEC qualified. That's the technical term that they use. And that means that we have submitted all of our, everything from the asset type, how it works, our thesis on it, how the fund mechanics are going to work, what the taxation is, the disbursement, liquidity, everything. And through some back and forth, and mainly I would say them refining and helping us get more clarity in how we're disclosing it. That's how they arrive at a qualified letter and it says, okay, you're qualified. You can now take this public. So we did that. And then now we do at least 2 to 3 amendments on a month-to-month basis with the SEC regarding the performance, the net asset value, new acquisitions, et cetera. And there's a lot to this, but I'd say the most critical point that someone should consider is that as part of this, we have to have audited financials. So as a small company, that's a bit atypical, but we have annual audited financials filed publicly. So everyone can really, you can double click and read pretty much everything about this company because we publicly file it.
What have your customers been saying on both sides? So what's the feedback been like on the CityFund side and then the people that are, getting the cash from you for their home equity? So
on the CityFund side, the most kind of common is that, how is this possible? What is this, asset? How does it work? How do I get into the city? This is great. And so that's a conversation starter. And so once they realize that they're investing alongside homeowners, it's very relatable, which is a core mission of ours, is make language and asset type, relatable. And so it's really rewarding in that way. In that, like, I can't believe you guys are making, real estate ownership so accessible. I went to school at UT and I've since moved to, I don't know, middle of nowhere, Arkansas. I like living in Arkansas in the middle of the mountains, whatever. But now I can own homes, like in my hometown. Like, there's a lot of pride in that. That's really rewarding to hear. Again, you kind of have the real estate nerds that want to double click on this asset type and like, how is this, made possible? What's happening with it? And then they get really big into like, this is going to be the next big real estate asset. We saw something similar with Invitation Homes and single family rentals when Blackstone came in and did that. And so there is a lot of positive signals towards this asset class, that being the home equity investment, being an emerging asset. So you have, again, kind of the nerdy investor talk digging into that. I think that covers kind of the broader gamut of the investors in CityFunds. And on the home share side, different times, but like earlier in the year, when it was a time where people were paying for like their kids to go to school, I at least interviewed 2 of our customers that were getting cash out of their home because they had all kinds of other pressures with financial stress that you can imagine. And they were using it to pay for their kid to go to school, different scenarios, but both that. So very heartfelt, very thankful for the product, which again is very rewarding. On the, kind of a different perspective, we have some people that own their homes outright and that are immediately taking cash out because they're like making an investment in something, like whatever it may be, a new property or something, and then immediately paying us off to do another one. And so it becomes like a more accessible account to them. Maybe if you could relate that to IRAs and the movement towards self-directed IRAs. So some people view it like that. Some people view it like it's a life savings. It's amazing that I can access this.
So to kind of take a more macro perspective on real estate, we were talking before we started recording about how access to real estate has really had a couple of different, let's call it segments in its history. The first big one being REITs, real estate investment trust. And, now I mentioned earlier, you had places like Fundrise, trying to go for more commercial, Yield Street, other platforms like that. So my question is why is what you guys are doing going to be the next great thing for the real estate market and for almost democratizing access to these type of investments?
Yeah, it is democratization. It's just that in our circles, maybe that gets too buzzwordy, so we don't use it as often. But it is factually that. You kind of think this, like, Robin Hood went to market with a great name, because I'm going to use the name, but I'm going to go back to the old fairy tale, right? Like Robin Hood. And so like what's happening with a lot of real estate today is a lot of institutions are buying it up and controlling it. And so if the alternative way to own real estate is hyper focused on commercial real estate, then you're not really solving that problem, because still you're losing out to so many institutions that are buying up real estate that individuals lose access to it, which is fundamentally perpetuating a problem that would have likely been the motivator for Fundrise and Yield Street and Crowd Street, some of these others that went to market like 10, 15 years ago. And that was like institutions have, historically 45, 50% of asset allocated to real estate. And individuals had, at the time, 5% or less than. It's always extremely lopsided. So they said, we got to solve this. But now that gap's not really being solved, right? Because commercial is a different subclass. So we're taking residential, first off, and we're making it very much accessible. So then you want to look at fundamentally why a REIT, like a publicly traded REIT, like comparing that to like any private real estate. Why is private different than public? Well, a public REIT gets put into the stock market. Even though it's foundationally based on the investments in real estate, it's going to move. It's factually, historically proven. It's going to move up and down with the stock market, even though that may or may not have anything to do with the underlying assets. So you get less correlation to the actual asset class, and you get a whole lot of trusty expert and a lot of buzzword that you can't really drill into. That to me is like so like commonplace that I don't think people really even consider that a REIT is investing in real estate anymore, which is, I think, proving the point. And then you have private real estate funds that have made it more accessible, which I think are the pioneers. I mean, what Fundrise did, they pioneered this as one of the reasons we can come to market with how they've done that. in Yield Street and Crowd Street too. So a couple of distinctions on that. It's the asset class. We're the only publicly available fund that allows you to invest alongside homeowners. And so from an efficiency and a growth fund manager standpoint, I don't have to find tenants. I don't have to manage properties. The person that owns it inherently is doing that, right? Because they have still a larger equity stake. They want it to be worth something. And I can go buy way more assets on the same amount of capital than a lot of other funds. So they end up being, they could have millions of dollars into a single commercial investment. And if that single commercial investment was impacted by, say, the new state of like normal after COVID around people going to offices or whatever, then you can't really hide from that. It's really hard to shelter that. But we have greater diversification because of the asset type and more efficiency in the management of it. So it creates this highly scalable product that where we eventually, the reason we built these as individual offerings is that we intend for each of them to become a publicly listed vehicle to where, in the near future, you will see in your app, you want to invest in real estate, you see the very simple thought, you can invest in Austin, you can invest in Dallas, Denver, you can invest in Vegas, et cetera. And that's the concept, so that you have it across the board and it makes it much more transparent and sustainable and scalable.
What I find super interesting about what you guys are doing is I feel like a lot of times in investing, and you could say real estate's a part of that, there's a winner and a loser, usually. But with this model, there's really two winners. They're the homeowners that are getting access to the capital that they need. And on the other side, there's people that are getting access to presumably, lower risk investments that are with assets that are very valuable in this country. So such an interesting idea. And to kind of pivot away from Nada, we've talked a lot about the company. I want to talk a little bit more about you. And you spiked my interest when mentioning this at the beginning, your punk rock background. So I guess maybe my question would be, why did that make you an entrepreneur, and why did that prepare you for entrepreneurship?
Yeah, it's a good question. I think it's more of a simple way to say, how does my mind work? Because if I found myself in a scenario where I did that, it kind of gives you the sense as to who I am. That's generally, if I'm just totally raw and honest, like, why do I say it? It's because it's a much easier way to be like, hey, I am this person, So I think it was always there. Just whatever that drive is to like, I am highly motivated to create something of value and bring people together. I feel very comfortable in that setting. And, and that motivation, was proven out in that. I mean, even that is like, people look back at being in a band and think it's really cool, but we all, like me and my friends, we took it so serious that we actually tortured ourselves because it was like really vulnerable. You get up there and you're performing it and it's like, hey, do you guys like it? Like, we didn't do covers. Like, we wrote and created our own. And at some point, some people liked it. But we took it very serious. And there's a lot of vulnerability and drive that comes into doing something like that I very much, rely on today still. And just like who I am.
That's super fascinating. So what would you say as an entrepreneur, during your time at Nada, you've learned the most? What are those principles that you've kind of been rooted in? And I guess if you had practical advice for other entrepreneurs, our listeners love to hear that. I love practical advice for the entrepreneurs in the audience. What would you tell them?
For me, like, my main virtue is curiosity. And so I would always say to myself or anyone else, and that is to stay curious. So, and that is, I guess that's another way to say, don't be afraid to pivot or whatever. Just think about like, what is it you're trying to achieve, and always be absorbing and get more efficient at how you absorb and how you manage time. But don't think you've got to turn it off and then just go to work, because if you turn it off and just go to work, you may be going to work in the wrong way. Or I don't know, it's the wrong thing. So it is so much around that. We're still in it. We're maybe coming out of it, and it's kind of like I have kids, so I look at this as like parenting. So it's like I'm in this stage where the company is starting to mature, that people really understand what's going on, and so at some point it's going to be like, yep, like this thing works at scale. Can we scale it? Can it go to college and get a career and can it do other things that I want it to do? But it's I formed it. I think it's really important to appreciate that time. Like, it's the grind, and it's a roller coaster. Like, you may be, losing everything in a minute, and then it's coming back. But I think you really need to appreciate that, because if you don't, you're probably doing the wrong thing.
So before we transition into your elevator pitch, I have two kind of final questions. You guys are raising on WeFunder. I want to mention that again, so the link will be in the description. My first question is related to that, and that's why should somebody want to invest in Nada? And my question that's kind of goes with that is, where do you see the company going in the next 5 to 10 years?
Yeah. So why would you invest in Nada? It would be fundamentally because you can recognize and identify with our mission, right? You can recognize and identify that residential real estate is this giant asset class that, typically speaking, anyone thought they did it not alone, right? Yeah, I can't access it. He likes a shitty product. So creating different products and different ways to access that is something that motivates you. And then, you should look then, how efficient have we been with capital? We've raised capital before. What have we done with it? And can it scale? And so if you want to look at it, the most simple, like we are this to that, you would say, okay, Robinhood, for all they've done since then, they did something really well. They took this asset class, stocks and bonds that a lot of the everyday investors weren't accessing. And they said, we're your gathering home. We're going to build everything to make this to where this is a home for you and get to give you exposure to this asset class. All right. So they made stocks and bonds as an asset class more accessible to a greater audience, very much intentionally. Coinbase did something very similar to another alternative asset, that being crypto. They focus on educating, bringing it together. They brought a platform to where you could better understand it. You could access it through investing. You can spend it on a card, all these different things where it fits into more normal life. And so we are doing the exact same thing, but to real estate. And if I start it just there, I feel like that's a very, very shallow thing to say, but very thoughtfully, we are doing that. And that is the scalability of the funds, the ability to deploy home equity in so many ways. If someone else is selling something to a homeowner, like Home Depot is selling home improvement, then we're not selling a financial product. We're selling how you buy that home improvement. It's just a new way to finance it. So it's very much mass distribution for that type product, similar to what we talked about where, you could be in your Robinhood app and you pick real estate and you just pick a city. That's a very simple concept. So we're building the same thing out to real estate.
Well, John, thank you for that. And I've thoroughly enjoyed getting to know your company and you. Such an interesting idea coming from an accounting background, something that I've never thought of with home equity, and such an awesome spin on it. So I wish you guys and Nada nothing but the best, and we'll be tracking your progress and rooting for you.
That's awesome. I really appreciate it.
Thanks for coming on, John. Thank you.
And for all our listeners out there, we will see you next time on the next Big Thing podcast. So long.
Bye-bye.